All right, let's dive into a recent technical analysis report on Opendoor Technologies. And this one is a real nail-biter. It's a story of a massive rally, a pretty scary drop, and a whole lot of conflicting signals that we need to unpack. So let's set the scene. Back in September, Opendoor's stock just went vertical. I mean, it absolutely exploded, fueled by a ton of optimism in the housing market. It shot up over 200% to hit a new 52-week high. Things were looking great. But, what goes up? The party did not last long at all. The momentum just vanished, and the stock took a steep, steep dive, losing more than a third of its value from that peak. A really sharp retracement. So this kind of wild swing has everybody scratching their heads is asking the same thing. What is going on here? Is this a huge buying opportunity, or is it a major warning sign? Well, to figure that out, we've got to play detective and follow the clues laid out in this technical report. Okay, let's get into the weeds here. We're going to start by just establishing the basic facts of the case, straight from the technical report, which is dated October 18th, 2025. So the report locks in the stock's closing price at $7.16. Now, that number by itself doesn't mean much, but look at the 52-week range. It's gone from just over 50 cents all the way to almost $11. That 716 price tag puts it smack dab in the middle, kind of stuck in this technical no man's land after that huge run-up and the big drop. Now we're getting to the good stuff. These are the numbers that really matter to a technical analyst. The report points out these key price levels, and you can think of them as like battle lines drawn in the sand between the buyers, the bulls, and the sellers, who are the bears. So the whole game right now is about what happens next. The price is literally squeezed between a support floor at 688, where buyers might be waiting to jump in, and a resistance ceiling at 734, where sellers are probably looking to cash out. The next big move really depends on which one of these levels breaks first. All right, so let's follow the first major trail of clues from this report. And I gotta tell you, right now, all the initial evidence seems to be pointing in one direction: down. So as we dig deeper, the analysis immediately flags the moving averages. This is a classic go-to tool that analysts use to figure out a stock's underlying momentum. And believe me, for Opendoor, these numbers are telling a very clear story. Now, if you're not familiar with moving averages, don't worry, it's pretty simple. They just smooth out all the choppy day-to-day price noise so you can see the real underlying trend. The best analogy is a river's current. And right now, that current is pulling Opendoor's stock price downstream. And here's what that looks like in the actual data. The stock's price is trading below both its 5-day average and its 20-day average. When you see both of those lining up, it's a pretty strong confirmation that sellers have been in control lately. It establishes a very clear short-term bearish trend. So based on this first set of clues, you'd probably think, okay, case closed. The stock's headed lower. But, like any good mystery, there's always a twist. Right when that downtrend seems like a sure thing, the report uncovers a whole other layer of evidence, a completely conflicting set of clues that suggests a sharp reversal could be just around the corner. And this brings us to this really key concept called oversold. The best way to think about it is to imagine stretching a rubber band. The further and further you pull it, the more tension it builds up for a really powerful snapback. Well, in the world of trading, that's exactly what an oversold condition can signal. The report really shines a light on this in the section on oscillators and momentum. It points out that several really important indicators, we're talking things like the Williams %R and the CCI, are deep in what analysts call oversold territory. This is a technical flashing red light that the selling pressure might be running out of gas, and our rubber band is stretched just about to its limit. And here it is, the core conflict of our entire investigation, laid out plain as day. On the left, you've got these trend-following indicators like the MACD, and they're basically saying, yep, the downward momentum is still here. But on the right, you have a whole suite of these other indicators, stochastic, Williams %R, CCI, and their job is to signal when a move has gone too far. And right now, they are all screaming that a rebound is coming, and soon. So this is the million-dollar question, isn't it? It's a technical tug of war. Do you trust the overall trend, which is this bigger, more powerful force? Or do you place your bet on these oversold signals, which are suggesting that very trend is about to reverse course? So how in the world does the report solve this puzzle? Well, in this final section, we're going to see exactly how it weighs all this conflicting evidence to come to a verdict. Okay, we've got a strong trend pointing down, but we also have multiple indicators flashing that a bounce is coming. So what is the analyst's ultimate recommendation here? Well, the report gets clever and splits its verdict into two different time frames. For the very short term, think 1 to 2 weeks, it actually recommends buying the dip. The idea is to bet on those oversold conditions triggering a bounce off that support level we saw. But for the medium term, it stays cautious, warning that the primary downtrend could easily take over again once that little bounce fizzles out. And this is all boiled down into one number, the overall technical score of 39.64. Now for these scores, anything below 50 is considered bearish. So this mildly bearish reading perfectly captures the report's conclusion. Yeah, the dominant trend is down, but that potential for a rebound is just too strong to completely ignore. So if there's one crucial point to take away, it's this difference. The analysis has identified a potential short-term trade, not necessarily a long-term investment. It's a tactical play on a quick bounce, with the very clear understanding that the bigger, scarier risks have not gone away. And that leaves us with the final, critical question every investor has to ask themselves when they see a setup like this. Are you looking at a genuine opportunity to buy low, a calculated risk? Or is this just a classic bull trap, designed to lure in hopeful buyers right before the next big drop? The answer to that question is going to define everything that happens next for Opendoor.